Very good afternoon to all of you. I am CA Gaurav Garg and welcome to today's session on can inflated stock statement given to bank trigger an addition under Income Tax Act. So it's a very interesting topic. Uh, Generally, we would have seen that the taxpayer or the enterprise, they take a loan from bank or a cash credit limit, and they might be doing the hypothecation or pledge of their stock, and they are required to give bank this stock statement to the bank. That stock statement may be as per the books, or that stock statement may be inflated. Let's assume if that stock statement lands up in the hand of the tax officer, what will happen? So this is what we are going to cover today. So let me share my presentation. This is my presentation. Someone told me, Gaurav, you must talk about yourself also. So briefly about me, I qualified in 2004 as a chartered accountant. I got the opportunity to serve as a Northern India Regional Council as the chairman in 23-24, and also as the chairman of Northern India CS Student Association in 21-22. Uh, I am a partner in a Delhi-based CA firm. Two of the knowledge initiatives that I run is one is the Tax Tribune, which is a LinkedIn newsletter, and the second is the Knowledge Cast, which you are live attending today. And the recording of the same would be available on my YouTube channel, Gaurav Garg, the Knowledge Cast. So this is the scene that we have. The businessman or the entrepreneur goes to bank for a loan. The bank says, okay, this is a good amount of stock statement which you are giving, and certainly your drawing power could be higher, but the actual stock or the value in the warehouse is lower. These are all arbitrary numbers. Do not do audit of them. Just for the sake of uh, adding some glamour to my presentation, I'm using them. Now let's say the assessment is there. The tax officer find out that the value declared in the stock statement given to bank is higher in comparison to the value declared in the books of accounts. Now he's just wondering, can the addition be made under section 69 of the old act, or let's say 103 of the new act, or can the addition be made under 69B of the IT Act 1961? So how I have aligned my presentation is, we're going to discuss briefly about section 69, 69B of the Act 1961 and 103 of 2025, because 103 practically merges 69 and 69B of 1961. Then we will see what are the various governing principles which are emanating from the jurisprudence with regard to these kind of facts. And before that, briefly, we're going to discuss the burden of proof. Once we are clear on burden of proof, once we are clear on the governing principles, then two latest judgments we're going to cover up wherein the addition has been prescribed by the high courts. And then we'll say goodbye. I will be happy to listen your view wherever you feel you can add value. You are most welcome. Just raise your hand or allow me to complete the presentation, and towards the end you can make your point. So section 69 of the Income Tax Act says, where in the financial year immediately preceding the assessment year, the assessee has made investment which are not recorded in the books of accounts. So in my last presentation discussion, we were on section 68. So in section 68, it was must that the transaction must have been recorded in the books of accounts. Whereas section 69 talks about when the transaction is not recorded, when the investment is not recorded. And 69 is applicable wherein the books are maintained or not maintained in both the cases. But today, what we are covering, the books are maintained, but the investment or the stocks are not recorded in the books of accounts. Or you have a 69B. In 69B, you have recorded the investment or you have recorded the stock in the books, but at a lesser value in comparison to what you have expended. So if you have paid $100 or 100 rupees, what you have recorded is only 80 rupees and not 100 rupees. In 69, you have not recorded. So whatever you have expensed, whatever you have invested, you have not recorded in the books. Now, if we go to the IT Act, what is happening? Sorry. 2025 Section 103. It includes both, where in any tax year, any investment has been made by the assessee, which is not recorded in the books of accounts, if any maintained by such assessee for any source of income, or the AO, assessing officer, finds that the amount of such investment exceeds the amount recorded in such books of accounts. Earlier, this was splitted between section 69 and 69B. Now you can see that both of these two things are merged in section 103. So now the facts that we discussed earlier, can be very well covered either under 69 or 69B or 103 of the new act. That value recorded in the books of accounts is 50,000, whereas as per the declaration given to the bank, the value recorded is 80,000. Now it comes in front of the AO and he wants to create the addition. So let's see what courts have held. See, everything starts with burden of proof. The first burden of proof is on the assessing officer or is on the taxpayer. With regard to section 69, there is a very celebrated judgment by Honorable Madras High Court in the matter of N. Swami, wherein the court has said the burden of showing that the assessee has undisclosed income is on the revenue. That burden cannot be said to be discharged by merely referring to the statement given by the assessee to a third party. In this case, it is bank. So just because there is some statement lying with the bank, which assessee has given, which may be differing from the books of accounts, can the department based on this say, oh, no, we would like to create an addition because the statement that you have submitted to the bank is, let's say, for 100 lakh rupees or 100,000 rupees, and your books of account is saying 95,000. So we'll create an addition of 5,000. The court, the Honorable Madras High Court, very importantly, has clearly said that just because there is a statement which has been given to a third party, that cannot be the sole foundation for creating an addition. Means the assessing officer needs to come up with something more to prove that the value recorded in the books is less or there is no recording in the books. That is what the N. Swami, in the matter of N. Swami, Honorable Madras High Court said. And it's very important. So whenever the taxpayer receives any notice with regard to these facts, it becomes important, what is the backup which assessing officer is having under section 69. Because if he is having a good appropriate backup, then the burden of proof shifts on the taxpayer to disclose the source. But if the officer is proposing an addition based on some, surmise or some thought process and not backed up by the appropriate documents, then the burden of proof is still on the assessing officer. Now, there are certain governing principles. If we see the jurisprudence which comes out on this matter are principle number 1, that mere discrepancy between bank statement and book is not conclusive. Just because there is a difference in bank statement and books, it does not mean the assessing officer can create an addition. So, couple of judgments on this. One is again of Honorable Madras High Court in the matter of APCOM, wherein the court observed that any addition on account of difference in stock can be made only on adequate material, but not arbitrary. So there should be adequate material. We'll discuss what adequate material is. But again, the fact was there was a difference in the statement given to the bank and the books. The court said it needs to be backed up by some adequate material. It cannot be arbitrary. Again, in Enswami, the what court observed, the assessing income is to be assessed by the income tax officer on the basis of material which is required to be considered for the purpose of assessment, and ordinarily not on the basis of statement which the assessee may have given to a third party unless there is material to corroborate that statement of the assessee given to third party, even if it is bank. So very clearly, the Madras High Court in both the judgments said it needs to be backed up by some adequate material, some solid document to say no, the difference, the statement given to bank is actually true. So there needs to be certain corroborative evidence, and it cannot be only bank statement. This is what the court observed. Now, principle number 2 is quantitative discrepancy is very important. It's decisive. Valuation difference alone is not sufficient. So let's say the quantity that one has submitted to the bank is 10,000 units, and in books also it is 10,000 units. The difference is only because of the valuation. Then the entry is recorded correctly. Then one needs to identify what is the reason for the difference in the valuation. So in most of the judgments, you will find that the courts have said if there is a difference in valuation, it's okay. But if you have difference in quantity, then they have taken it seriously. So High Court of Gujarat, Honorable High Court of Gujarat in the matter of Virdeep said the assessee has submitted the bank statement with inflated price of the stock. There is no difference in quantity of the stock. The difference is only of inflated price of the stock, which has been given to the bank. And then they have uploaded the findings of upheld the findings of the ITAT, that because there is no difference in the quantity, there is difference on only with regard to the valuation, that is inflated, which taxpayer is saying it is inflated. And the assessing officer is not able to prove that the value recorded in books of accounts is not correct. And hence they have said, okay, we will delete the addition and upheld the order of the ITAT. Similarly, in Lakshmi Engineering Industries, what court observed, and Honorable High Court of Rajasthan, with this, so far as the case in hand is concerned, is stand as much at a higher footing, in as much as positive finding of the fact has been recorded by the learned tribunal, which may be repeated by us being as under. Beside, we find that AO had not been able to point out any discrepancy in the quantity of stock hypothecated to the bank and the quantity of stock as per books of accounts. So in both the cases, the court placed a reliance on the quantity, and being the quantity as per the bank statement and as per the books of accounts was same, there was no addition. The third principle is physical verification of bank. So when the taxpayer or the enterprise is submitting some statement to the bank regarding the valuation and regarding the quantity, whether that quantity and valuation is being verified by the bank or not. If it is verified by the bank, then that statement becomes an authoritative document, a document which can be presented in the court of law. But if that statement is not verified by the bank, then that statement loses the value. So let's see what court has to say in the matter. Again, the High Court of Punjab and the Honorable High Court of Punjab and Haryana, in the matter of BT Steel, what they observed, the assessing officer not only had the bank statement before him, but also verification thereof by the regional office that the stock was actually lying with the SSC. So the verification was done. The SSC was given due opportunity to explain the difference, but it could not give any satisfactory explanation. So now when there is a verified statement, the statement which has been verified by the bank officer, based on which the credit limits or loan was given, Now that bank statement becomes very important because now that is the bank statement to which the taxpayer or the enterprises have also agreed, and also the bank has also agreed. Now both parties have the consensus that on this particular date, on this at the end of this particular month or a quarter or a 6 month, whatever, that this is the value of stock, this is the value of inventory, this is the valuation of the stock, and that document goes to the court, then court will going to put reliance on that document. And they, as they said in BT Steels, if the opportunity would be given to the assessing officer, see, the burden of proof shifted from the assessing officer to the assessee कि भाई आप बताओ whether the statement is correct or not, because now it is verified. And if the taxpayer is not able to prove the otherwise, then the addition would be based on the bank statement or statement to the bank. Again, a very old judgment by the Honorable High Court of Allahabad in the matter of Khan and Sirohi Steel. The tribunal has also found that there was actually no verification of the stock made by any bank official. The learned state and counsel could not point out any contrary decision to show that a practice to inflate stock hypothecated with the bank with a view to avail higher overdraft facility is not prevalent in the business community. So what court said, that being there is no physical verification, generally the people, they inflate the value and give it to the bank. So the court said we're not going to place reliance on the unverified statement. So verified vis-a-vis unverified. In BT Steels, the Honorable High Court of Punjab placed reliance on the verified statement. In case of Khan and Shirohi, Honorable High Court of Allahabad said we're not going to place reliance on the bank statement because a statement to the bank because it is not verified. Let's see another ruling by on ITAT Amritsar, Honorable ITAT of Amritsar in the matter of Tilak Rice Mills. Stock statements to the bank were based on rough estimates and not on actual physical verification. So this is what happens. If the stock statement which has been submitted to the bank is not verified, then anyone can say it is based on the estimates. They are rough estimates. Because every month or every 6 months, it is not possible for me to do the physical counting or what is the value of my inventory. So on a basis of rough estimate, I am giving or submitting the statement to the bank. In that case, we have seen, in Khan and Shirohi, what Honorable High Court of Allahabad said. And I think similar view came up in the matter of Tilak Rice by ITT Amritsar. But once the statement was verified, the Honorable High Court of Punjab and Haryana ruled or placed reliance on that on the statement given to the bank. Hypothecation versus pledge, the Honorable High Court said if goods are pledged, then it would be a different view. If goods are hypothecated, then it could be a different view. They said pledged, basically, what you do in pledge, you keep the stock with the bank. So the physical count is something controlled by the bank. But when it comes to the hypothecation, the goods remains at the warehouse or under the control of the taxpayer or the enterprise. So where there is a pledge, where the stock, the inventory is under the control of the bank, there in the statement of stock will generally hold more value in comparison to a statement which belongs to a hypothecated goods, that is the goods which are lying at the warehouse of the taxpayer and not of the bank. Similarly, in BT Steels, the same thing happened. But the stock being hypothecated with bank, the bank has to inspect the stock. And this was the procedure explained by the bank authorities when inquiries in this regard were made by the AO. So they said even if it is hypothecated, then also the verification was done. So it's not only about hypothecation versus pledge, or it's not only about the physical verification. So the point is the statement on which the one is playing reliance are only based on some estimates, or they are based on some proper audit verification by a bank. If it is based on some proper audit or verification by the bank, then certainly the reliance or the faith, a court will going to play more on that bank statement. Let's see what happens in Devi Dayal Rice Mills, ITT Amritsar. In the instance case, it appears the AO made the addition only on the basis of stock statement submitted to the bank. It is well settled that there is a real difference between pledging and hypothecation, because in the case of pledging, the goods remain under the lock and key of the bank and they are liable to be physically checked and examined. But in the case of hypothecation, such good remains in the custody of the SSE and the physical verification of the goods hypothecated to the bank is not normally done. So that is the key point or key difference which we need to understand. If the stock statement is based on some physical verification, whether the goods are hypothecated or whether the goods are pledged, then certainly the courts will going to play reliance on that stock statement. But if it is not physically verified, then the uh, admissibility of the stock statement before the courts or before the tribunal goes down. Generally, in case of pledge, because the goods are lying at the warehouse of the bank under the control of the bank, one can safely assume that the stock statement is properly verified. It must have been drawn by the gatekeeper or the stockkeeper, must have been verified by the officers of the bank. Thus, the admissibility of that stock statement goes up in the tribunal or in the court. Let's see, based on these principles that we have seen, what the Honorable High Court of J&K and Ladakh has said in the case of Ajay Foods. Let's see the facts first. The appellant is a partnership concerned engaged in manufacturing of soya nuggets from soya beans, had availed a cash credit facility from bank against hypothecation of stock and mortgage of factory land building machinery. It furnished a stock hypothecation statement on an estimated basis, later admitted that inflated figures were shown to obtain higher cash credit, the bank accepting the statement without verification. And these were the differences in the bank statement and as per the books. So as per the books, the soya was 20666 kgs, whereas 60,000 as per the bank statement. Similarly, soya nuggets was around 2,573 kgs, whereas as per bank statement it was 8,000 kgs. The total difference in value along with the quantity was 7,77,000. The assessing officer called for bank statement, confronted the discrepancy and recorded the appellant's explanation that inflated estimated figures were furnished to secure higher cash credit and that bank did not verify stock physically. The bank also confirmed that no verification of the statement dated September 2000 had been undertaken, holding that the appellant failed to furnish true and correct particulars. The AO made addition of 7,77,000. So now, based on our earlier judgments, the stock statement is not verified. But we also said that if there is a quantitative difference, the addition can be prescribed. On appeal, the commission appeal reduced the addition to 7 lakh by allowing 10%. So the rough estimate based on the estimates that the value could be based on the estimate. So 5 to 10%. There are other case laws also wherein you will find the commissioners are allowing. In this case, they allowed the 10%. The matter went to the tribunal. Tribunal, what they noted, that there is a substantial discrepancy and hence they prescribed the addition. They upheld the addition made by the Commissioner of Income Tax Appeal. Now the matter is in the High Court. Let's see what High Court has to say on this. The case differed from earlier precedent because the SSC had specifically declared that quantity and value of stock to the bank and certified that figures were true, accurate, and matched the books of accounts. So now there are 2 points. One, there is a quantitative difference. Second, the quantitative discrepancy is among us huge, more than 5 or 10%. Third, the SSC has himself said it is true, accurate match to the books of accounts. Now, when the opportunity was given to the AO, to the SSC, he failed to provide any convincing explanation for these differences, except the figures were inflated to obtain higher cash. Now, on one side, you have written yourself that the statement which I am giving to the bank is true, it is correct, and it is matching with the books. Also, the discrepancies among us, there could be a human error of 2, 3, 4, 5%, but in this case, discrepancies among us. So you are yourself agreeing that this is the value. Now, when it goes to the court upheld what the CIT and what the tribunal uh, noted. The what court says, since the SSC has expressly certified the correctness of stock statement, the AO was justifying in relying on it for making the addition. And the judgment came in favor of the taxpayer. Now, another matter by Punjab and Haryana High Court in the matter of Lumba Manufacturing Syndicates Ludhiana. The SSC firm had availed an overdraft facility from its bank against hypothecation of stock. The AO made an addition to income based on stock statements furnished to the bank for drawing power. In an earlier round, the High Court held that unassigned stock statement, they were not signed. So the matter was remanded back by the High Court. Now it is the second round of litigation which is going on. In second round of litigation, what the fact is coming up? The facts comes up. The AO examined the bank successor's deputy manager who explained that stock statement were prepared by the godown keeper, required a partner signature, and formed the basis of determining drawing power. The AO again sustained the addition. Now, this point number 4 will indicate that this is something which is verified. So what court observed? The High Court noted that remand directions had been compiled with the AO. The SSC was given opportunity to cross-examine the bank official and disapprove the authenticity of the stock statement. The deputy manager confirmed the stock statement were prepared by a bank's godown keeper, required a partner signature, and were essential for fixing the drawing power. The SSC never claimed that it had not availed the overdraft facility. So let's stick to this point. Point number 2, this row number 2, prepared by bank's godown keeper. So as you know, the stock statement given to bank is verified by a bank employee, the admissibility goes up. So same thing happened. The High Court upheld the addition based on the stock statement was justified. So now if we quickly revise, what are the principles that we have seen, and then we can take up the questions. So first principle is just because there is a discrepancy, no issues, the officer must come up with some adequate material in order to prove that bank statement can be relied upon. In two of the Honorable High Court judgment that we have seen, one was actually verified by the assessee, and verified in the sense they said it's true and correct. In second, it was verified by the bank godown guard. Quantitative discrepancies is decisive. So in J&K and Ladakh High Court judgment, there was a huge quantitative difference. Same principle applies. So if there is a quantitative difference, then, and if it is more than, let's say, 5 or 10%, then it would be tough to come out from the addition unless somebody explains why there is a quantitative difference. Physical verification by the bank in the Punjab and Haryana High Court matter in the case of Lumba Manufacturing, we have seen that the bank statement was physically verified. So certainly there was an addition. Hypothecation versus pledge, in that though it was referred as an hypothecation, but the fact was that the inventory was taken by the bank godown keeper. So one can assume that in that case also in Lumba Manufacturing, though it was hypothecation, but the stock was lying with the bank. So these are two latest judgment in this matter, Ajay Food Products and Lumba Manufacturing by Honorable Punjab and Haryana High Court. I think I am done with my presentation, but a brief guidance for all of us, for the taxpayer and for the SSC. When one is facing the scrutiny of stock statement, SSC should ensure that he is able to demonstrate these following 7 points. One, there should be a proper reconciliation between the bank statement and the book. So if the officer asks for why there is a difference, you can always give the reconciliation. And if something is not covered within the reconciliation, and if that is minor, you can always say it is based on the estimates. One should keep and maintain documentary evidence confirming that physical verification of stock was never undertaken by a bank. So it's very important. So if there is a stock statement on which the assessing officer wants to place reliance, and if you prove that it has not been verified by a bank, then the admissibility goes down. But that document you should have. Because if tomorrow, let's say the banker change, and he's just giving the theory to save his job, then you would be land in trouble. So whether it has been verified or not, you should have a proper entry exit register. The taxpayer should be maintaining, through which he can prove that the banker never arrived to his godown for verifying. So all this stuff needs to be maintained. Preserve contemporaneous correspondence or internal notes, whatever. Let's say you are saying to a bank that it has been verified by me, it has not been verified by the banker. Why don't you come for the verification? If banker is not coming, then all those documents should be there with you. Ensure books are audited. One can place reliance on the books, and certainly it is as per the auditing standards. If any item in the bank statement represent a third party stock, then it should be properly documented. So it should not happen that the tax officer will say this is the difference coming up. And that difference, let's say, might be coming up because of third party stock lying in your goods. Maybe you are a job worker, maybe. So that reconciliation should be able to prove that this difference is because of some third party stock. I'm not sure on point number 6, but if one can avoid, then one should avoid saying it is true and accurate. The statement of accounts, statement of stock which you are giving to bank, if you can avoid doing this, one should do true and accurate, because true and accurate means at that time, this was what the value of stock and the quantity of stock was lying in the books. Hypothecation and pledge, if it is lying in the bank godown, I think then the reliance on the stock statement goes up. But if it is not lying in the bank's godown, but if it is lying in the godown of an enterprise or a taxpayer, then I think the stock statement admissibility depends upon the physical verification. So this was with me for all of you in today's discussion. If you have any point to make or query to share, feel free to do that. I would be happy to listen to your view, because learning is always mutual.
Very nice.
Mr. Natarajan, you want to say something?
Yeah, but is it only applicable only for you have been only on the stock, because the drawing power also includes for the receivables and also for the creditors, for the payables. Correct. So
Yeah.
is it only if the misstatement happens on the payables and the receivables, is that also leads to the addition?
I think we can apply principle there also. So if your receivable and payable are based on the estimates and they are not based on the books, I think these principles can be applied. But generally, receivable payables comes from the books, and if they are properly recorded, I think the admissibility of those documents should be on the higher side.
The other thing is that the method of treatment of the kind of the for the purpose of books and for the purpose of the reporting. For example, take a case. For example, the company has a what you call a provision to recognize the materials in transit as a as a goods which has to be reported. But by oversight, the invoice has not received, and the stock statement for the audit they have not taken. So whereas that kind of discrepancy, if it comes on the principles of accounting, in terms of stock in transit, whether it has to be a part of the stock, irrespective of whether it is there in the godown or not. So whether that kind of this one leads to a discrepancy in the quantitative mechanism. So
Sir,
how
I
do you
think
interpret it?
I will say it is certainly a discrepancy, but a discrepancy which can be explained. So why the stock has not been recorded? You are clearly saying it's because of the accounting principles. So this stock has not been recorded, let's say in financial year 25-26, but it might get recorded in 26-27 when you are in physical receipt of the stock. So where the one can easily able to explain the difference, and that too because of the accounting, then I think the income tax rules will apply. How you generally compute income under the income tax rule. So under the income tax rule, the accounting standards and the income tax computation standards are very much aligned. So I think the books of accounts will have more reliance in this case, in your case, rather than the statement given to the bank.
Because in one case, for example, nowadays, even for the drawing power, other than the conventional inventories and receivables and payable to arrive at the drawing power, the now the banks are also accepting for the government receivables as a kind of a part of a receivables. For example, GST as a part of if we have got an inverted tax mechanism by virtue of that GST ITC as a credit. Okay. So
Sir,
where I
that
think there is a kind of a dispute between the
See,
assessee
I,
and
I
this
think
one.
that Rajan sir, see the point comes,
Huh?
as the court said that
Uh,
it needs to be, okay, whatever you have included in order to get the credit limit, that's okay. But
uh,
the same should constitute an income or an
uh.
asset also from an income tax perspective.
And that constitutes as an income, na, yeah. See,
Yeah,
when
that's
you
what
are
I'm
there,
saying.
when you are
So it,
there,
it
no,
is.
listen to me. When you are there as an the inverted tax duty structure, where outgoing goods are at 5% and your input are at 18%, so you end up with a every month of 13%. Especially when you are also having an export also. Okay, not only domestic. So you resulted basically every month say 40 lakh, 50 lakh kind of a, what you call a duty which is receivable from the government. So that
Mhm.
is apparently it is basically an income. Okay, whether the government or but in those cases, whether if the bank accepts that as a kind of a what you call a for the purpose of drawing power, so whether that will be treated as a kind of a
No, no, sir. For
differential.
the purpose of Income Tax Act, we need to go by Income Tax Act whether the same would be considered as income under the Income Tax Act or not. So the bank might have considered it for their own purpose, but I think the difference is very much explainable. So just because bank has accepted, the tax law should not accept this. So tax law would be governed by the tax law and not by what bankers feel. If tomorrow bank says no, no, I will not consider this an income, will assessing officer going to leave that valid income, as non-taxable? I think that will not happen. So we'll go by, what the act says in that case. Thank you, sir. Any other point or any other question? Okay, so no questions. Thank you for joining, all of you. I think I trust you must have enjoyed this session and must have been value add for all of you.
Really, it is a very thought-provoking session, and basically, what are the kind of you have highlighted a risk on this one, which are all being casually done by almost all the companies, in order to inflate the stock. But you have already highlighted the what are the consequences of that if the same statement lands into the wrong hands, and then the honors of proving that that all those things was really educative.
Thank you,
Appreciated,
sir.
very well appreciated. Yeah,
Thank you. Thank you, sir. I will be circulating this recording after uploading on a YouTube to all of you. Uh,
absolutely.
See you soon in my next session. Thank you. Bye bye.
Bye bye.